But let me invite on the show Devina Mehra from First Global. She joins in to talk about the markets and where we're headed. Devina, thank you very much for joining in. This is Rima here. Markets are juggling so many signals, from the escalating tariff threats to earnings, now the RBI policy. Your thoughts on the markets, its positioning right now, and where we're headed?
I think a lot of it, in the moment, we make a lot out of every news flow, but we who have been in the markets for decades have seen much go on. There've been everything from the plague to COVID to wars and every year. So this for me, it's like whatever 31 years. There's been a union budget which has changed taxes and tariffs. So I think there's no point getting caught up too much in the noise of the moment. And if you step back and look at it, I don't think there's a risk of a major crash. I mean, not that there can't be any downside from the market. But overall, my advice has been that whatever is your equity allocation, you should remain invested. And the second part of that is that you should not have 100% in equity, then you should not have 100% in India.
So not 100% in equity, not 100% in India. So what would the portfolio split look like right now? Of course, it's different for different people, but just trying to understand what are markets factoring right now, and if there are any other asset classes that you are liking right now, Devina.
So first of all, as I said, don't be 100% in India, and let me give you a sense of why I'm saying it. And the second part of that is that US is also not the rest of the world. I mean, there's a whole wide world out there. For example, if you look at the currency side, it looks as if the rupee has not depreciated that much this year, because against the US dollar, it's gone down only 2.2%, but it's gone down almost 15% against the euro and against the Swiss franc, about 9% against the pound. So that is how your savings or investments can get eroded. And when you are planning for financial goals, which are 10, 20, 30 years ago, later, you cannot factor this out. And when I started working, the dollar was 12 rupees. So if I had not thought of this somewhere along the way, I would have lost 90% in currency depreciation alone. So that's the wake-up call that every Indian must look at. I mean, it's very simply, don't put all your eggs in one basket, even if you think it's a good basket. That is why, I mean, this is a real cause for me, and that's why at First Global, we have something where people can get a true global exposure across asset classes, across geographies, starting at only $10,000, which now, of course, is 8.8 lakh rupees. So that's the very important part. Although, as I said, it's not as if that I have a view of any looming disaster in Indian markets. So whatever is your India equity allocation, also you should remain invested, but never have 100% in equities.
Devina, good to have you on the show. You know, would gold be one of those baskets where you would put your eggs into? Because as a matter of fact, as a safe haven asset, you would believe that with all the headwinds surrounding us, the prices of gold will only go higher in the near future. May not be in the immediate term, but over a period of time, the asset itself is up almost 30% in 2025.
So first of all, on gold, yes, it should be part of your asset allocation, except that it should not be a very big part of your asset allocation. Right now, as we speak, we are a little more positive on silver rather than gold, but that's an aside. You spoke of gold as a safe haven. Please go and look at the 50-year chart of gold. In dollar terms, the price of gold in 1980, it reached one peak in 1980. So 19 years after that, in 1999, it was actually still down 60% from that 1980 peak. After 19 years, it was down 60%. It reached the 1980 peak again in 2007. So it is 27 years. Then the next peak, it again fell 40%. In dollar terms, gold has been more volatile than equities, whether you look at S&P or whether you look at global indices. That's how volatile gold is. It is no safe haven. The only reason gold looks fine to Indian investors is the rupee chart of gold, which is essentially a rupee depreciation chart. So it looks good in rupees because rupee has been depreciated over the against the dollar over this period of time. And that's why our grandmothers were not wrong in buying gold, because at that time, gold was the only currency hedge. You could not invest in overseas markets. It was prohibited. Now you can invest. So gold is not the only way to get an international exposure.
So what percentage of the portfolio would you have in gold/silver? And for pure Indian equity markets, what would your top bets be?
So gold is an asset where you, at the maximum, you can have between 5 and 10%. It's not an asset where you should have 25, 30%. And I would say gold and silver together. And in terms of the Indian markets, we have been overweight pharma and healthcare and auto components since the beginning of 2024. We have trimmed a bit here and there, but we would still be overweight. FMCG, we are overweight, though again, there has been a change in the stocks, and some of the larger stocks that we had been holding for years, we have got out of, we've got into stock, not really small stocks, but smaller than the very large caps. And so those are sectors we would be overweight. We'd still be slightly overweight industrial, slightly overweight IT. And there are sectors like real estate, energy, utilities, where we will be very underweight. Banks, while we are not overweight, we are holding more than we used to. So we're still somewhat underweight, but we are holding more than we generally did in banks, because I'm a nervous investor in banks.
No, you've spoken about this in the past, but this auto comms is not Trump insulated, right? So explain to us that, things are very uncertain and predictable now on the tariff front. And also on pharma, do you think it is at risk?
Actually, see, it's always a bottom-up thing. So the sectoral allocations are not top-down for us. They are a resultant of the stocks we pick. And we have checked that most of our picks in both pharma and auto components are more domestic oriented. So that's so they do not have that much of an exposure to the US. So that's the pattern. It turns out which our systems liked and where we are invested, and which is the reason why we have not gone out. However, on pharma, I have a view that on one hand, Trump keeps talking of bringing down healthcare costs for the US citizens, and really Indian drugs are the least expensive option they have. So whether it would make sense to really increase the healthcare cost further. So that's a separate thing. But as I said, our portfolio is more domestic oriented in both these sectors.